Well, I look forward to chatting with you tonight. I've learned a lot this summer. It's been terrific. I've really enjoyed each of the series. What I'm hoping to do tonight is have a little bit of a question and answer time here coming up, so you be thinking of your questions, and we'll try to do that. So I want to take you back just for a minute. I want to start by talking about just a little bit of the power of the market. And I want to take you back not all that long ago, just back to March of 2020. You know, a month we'd love to forget, right? That was a pretty disconcerting time when COVID had just hit. Those of us that were at BJU, if you recall, we had to have our spring break, and we had to turn on a dime there to get our classes, online. Well, during that time, it was a very disorienting time, and for a lot of people, especially with health issues, it was a very scary time. So my son, who was 31 at the time, he called me about midweek, and I'm immersed in my BJU stuff. I'm all over the place, right? Like if you recall that time, very distracted time or whatever. So he calls me midweek and he goes, "Dad, isn't there a saying about investing that says, be fearful when others are greedy and be greedy when others are fearful?" He said, "Isn't that an old saying?" That's a Warren Buffett quote, or he's given credit for it. And I said, "Well, yeah, Jared, that is a good point." He goes, "Well, don't you think people are pretty fearful right now?" And I said, "Yeah, there's no question. This is a very fearful time." And he goes, "Well, then why are we not investing?" And I said, "Okay, all right, I guess you're right. Okay, so we probably ought to invest." So, we got a little bit of fun money together. He made a little investment portfolio, and I did as well. And we had a lot of fun with that. We compared notes and commiserated and had some fun. So we can come back and chat about that a little bit later if you want to. But during that same time, I had a rental property that I was getting ready to sell. And again, we can come back to that topic as a question if you want to. But in the process, I was over at Home Depot and Lowe's quite a bit during that spring. And if you recall, it was really weird because everybody was supposed to be wearing masks except at Home Depot and Lowe's. You could go in there and be packed in there. Nobody had masks on. And it was just like business as usual, So I was in there every week, it seemed like. And I wish now, looking back on it, what if I had taken the good impulse to invest, and then what I was observing at Home Depot, why didn't I just buy some Home Depot stock? And if I had, I would have doubled my money. I would have gone from 156 to 329. And frankly, it was up to about 421 at one point. I think it was even higher. So it's like, wow, why didn't I just put those two ideas together? Well, the second thing I did a lot back then, and some of you young guys, anybody like to eat at Chipotle? Yeah, Chipotle's a pretty good place. A lot of the college kids, I think, have a membership there. They have it on their phone. And so I got the phone app, and I was stopping in at Chipotle. Well, again, what if I'd taken that great impulse to invest when others are fearful, and what if I'd bought Chipotle back in those days? Well, it was at $465 a share, and it's now at $19.02 per share. Amazing, up 4 times. And again, these are businesses we completely understand. We frequent these businesses. These are not complicated things. And my goodness, who would have believed a four times up deal on Chipotle alone? So one of the things, as you know, if you follow the Dave Ramsey material, or we were chatting earlier, I really got my start back in the Larry Burkett days. So some of you oldsters, you'll remember Larry Burkett. He's Dave without the dazzle, right? He's Dave without the showbiz. But if you'll recall, one of the things that we were all taught was you buy mutual funds. Don't buy individual stocks, and we can come back on that one if you want to. But a mutual fund, as you know, is just basically where a manager has been hired for many millions of dollars to basically buy at least 100 different stocks, or maybe as many as 300 stocks, and own them in a single mutual fund. And so I want to give you an example of a mutual fund that was begun back in 1934. And I love this particular mutual fund because this is a real life story. It's not a model or not a hypothetical. It's a real fund. And that was the year my mom was born. So she's a member here at Morningside. And so, she's 89 years old now. And so I love thinking back to those days. They were still chasing down, Bonnie and Clyde back in that year. And I think they took care of Dillinger that spring. So that was what was going on back in that era. It's kind of fun to think back to that. So let me ask you a question. If you invested $10,000 in this particular mutual fund I'm talking about, it's called the investment, I've got a little example. Yeah, Investment Company of America Mutual Fund. It would have grown quite a bit through December of 2022. Don't you think it would have grown quite a bit? How many of you think it would have grown? 10 grand would have grown to at least $1 million by the end of December of last year. All right, pretty easy guess. It's going to be at least $1 million. How many of you think that money would have grown to at least $10 million by the end of last year? At least $10 million. How many of you think it would have grown to at least $200 million? Anybody think it would have gone that high? $208 million. $208 million is what that fund did. Now, What they've done is they've diagrammed it. I'm going to show you this little diagram in a minute. This is my visual aid. Remember freshman speech? You have a visual aid? This is my visual aid. We've got to be the silliest visual aid I've ever brought to a presentation. But I'm going to pass this around in just a minute. But one of the things that I think a lot of people would say, well, Jeff, I've heard a lot of presentations, and I know the market has great power, and I know it can grow money, in this case, over my mom's lifetime, 10 grand to 208 million. I mean, amazing. But I think a lot of people would say, but Jeff, I just don't know if right now is exactly the right time. Now, before I flip my slide, let me tell you one other quick thing. When I hand this around, this chart is not drawn to scale. Obviously, to put a scale like that, if I had to put this on the floor, does anybody have any idea how big the piece of paper would need to be to picture $200 million over 10 grand? Any idea how far that right-hand edge of the paper would have to be? It would have to be as tall almost as the World Trade Tower. It would have to be 1,740 feet tall to picture 200 million growing, out of 10 grand of an original investment. So this is not drawn to scale. So that would be quite a piece of paper if we had that available to us. But I think a lot of you would say, yeah, Jeff, but I know the market's good, but really not right now. I mean, of all the times to invest, think about this. We've got a war going on in Ukraine. We've got the Biden administration, and all the politics are just in disarray. We've got inflation. Of all the times, just not right now. I mean, I understand the market's good, but not right now or whatever. And so the reason I want to hand this around to you, and I'll pass it, you guys can pass it around. What these folks have done at the Investment Company of America, this is called an American Funds Mutual Fund. But what they've done is they have listed in every one of these 89 years, they've invested, they've shown the reason you should not invest in that particular year. There has been a reason in every one of these 89 years, a really good reason. The beginning of World War II, or, Pearl Harbor, or, John F. Kennedy's been assassinated. There's been a great reason every one of these 89 years not to invest. And yet, the people that did invest, they made 10 grand to $208 million, right? So in every one of those years, there was a reason not to do it. So I want to pass this around, let you guys take a look at that. And just to me, a really vivid reminder that you don't want to wait. You've got to jump in now. So let's dive in just a little bit. Here's how I want to play the game here tonight. I was here for the DARS presentation, and you all did a wonderful job asking a ton of questions. Those guys were experts. Man, what a joy. I mean, man, they had a lot of information. So I'd love to recreate that for you here just in a minute. So I'm going to give you a broad overview and some trends, and I'll see the way along, and suggest some questions if you want to come back to it. And we'll do that. And then what I'll do right around 6 is I'll give you just a couple of final thoughts, some suggested reading. And then those of you that need to leave at 6, you can leave. And if you want to hang around a while, I have nowhere I need to be tonight. We can keep chatting if you want to hang around a little bit after that. So, and there's my contact info if you want to get a hold of me. I'll tell you a little bit more about my bio here in just a second. But I teach accounting at Bob Jones. So I'm easy to track down at Bob Jones if you want to chat with me over there. Okay, well, let's dive in for a second. So if we're going to talk about investing, one of the first things you need to ask yourself is, where am I going to get financial advice? Who am I going to rely on? What am I going to read or listen to get advice? And one of the things I would simply say is use what I would call as a qualified investor, and I'll go on in a minute and tell you what I mean by qualified. And then I would encourage you, and I think this summer series has done exactly that, is we've been getting advice about day-to-day finances from Kimberly and insurance from the Jeff Darst, and then also Sean talking about estate planning. Those are the kind of things we're getting information from people that share our values. And that's extremely helpful to know that you're being talked to by people that don't have some sort of ulterior motive in the game long beyond, other than just trying to help you. So that's really neat to see that. So anyway, I am a certified public accountant, been that for many, many years. I teach accounting at Bob Jones, and then when I'm not at Bob Jones, I do have 5 licenses in the area of finance, of financial instruction. And when I say I'm licensed, and what I think that brings to the table is, I was just telling Pastor Horn here a moment ago, is it makes you a little bit more cautious. I have to have malpractice insurance, and so I'm a little more circumspect in some of the things I say than like a Dave Ramsey could be when he's a radio personality, and he could kind of say things a little bit shotgun that a licensed person is a little more cautious, a little more careful in how they describe that. So again, I'll just seed this slide with a couple of things. If you want to come back, we can talk about life insurance later. I would suggest that it happens when your first child arrives. We can talk about long-term care insurance if you want to. Now, down at the very bottom, I'd give you 2 warnings. I'd be very careful buying from an advisor where everybody that comes out of his office has the exact same product in their hand. A few years ago, I had a guy come to me and he goes, I just bought, he said, I just came from somebody was my advisor. And he said, I'll show you what they sold me. I said, you don't need to tell me what they sold you. I already know what they sold you. And I described it to him. He's going, man, how'd you know that? Well, because like the last 5 people in here, they've all been sold the same thing. So be careful, be careful of that. And then I would be careful listening and buying from people on the radio or by the ads on your podcast. I mean, I would just be kind of careful on that. We can come back to that later if you want to. All right, so my expertise, and I say this tonight just to kind of put some guardrails up around the conversation because I'm going to admit some things that I know I don't know a lot about. So I want to be clear on that. My expertise is mostly what we call financial investments, things related to the market, things related to the insurance market or whatever. I really am not a real estate expert, so if you want to get into real detail, I've owned a couple of rental properties. I've got some working knowledge in the world of real estate. I am not a real estate expert, so I'll probably be very deferential there to the young Mr. Darsk, on that one. So I'm not an expert. In terms of what we call alternative investments, I am licensed in all of these things. I have a pretty good knowledge. I'm not a huge fan of them for most people, and we can get into why. And that would include commodities, that would include private debt, private equity, REITs, things like that. Then at the very bottom, if you were here a couple of several months ago now, Nathan did an awesome job. Nathan Crockett did an awesome job talking about some things he's doing in commercial real estate and investing directly into small businesses. I'll defer to him on that one, okay? That's his world, not mine, and he is fabulous. He's incredible. So I'll leave that for him. Okay, when should you invest? Very simply, when should you invest? And the answer is you should invest now. Now, I'm going to put some qualifiers around that. When we say you should invest, what I'm saying is for sure at work. And most of us at work, even us at PJU, even though you'd think we are a nonprofit, we're actually not a nonprofit. And so we have a 401k. Probably here at the church or in a lot of other nonprofits, you might see something called a 403b plan. That's virtually the same thing. If you're self-employed, you're probably doing things through an IRA. And so those are all kind of describing the same kind of investment opportunity. And so generally our advice, I say our, the Ramseys of the world, and again, going back in the day, the Burketts of the world, would say always participate in those plans at work at a minimum, at least to capture the matching opportunity given by your employer. Now, probably you ought to be doing a lot more than that. As a matter of fact, that's my next point. Ramsey says we should all be doing about 15% per year. Now, that's an awfully big number, and I don't know very many people that hit that particular number, and he gets criticized for it, and he's got kind of an interesting answer. His answer is, well, when you tell somebody in their 20s they should be doing 15%, he said that sounds crazy, except when you meet, when you know all the people I've met that are in their 60s that don't have a nest egg at all. He said, then you realize that's why I go back to those people in their 20s and tell them to, save 15%. So he's got a pretty good answer for that one. And then the other thing I would tell you is, not until you've done everything Kimberly told you to do. So you got a whole lot of work to do under her suggestions a few weeks ago. And so for me personally, just to give you an idea, it was around age 37 by the time I felt like I'd gotten several things squared away to where I was going to do investing apart from what I was doing at work. So what I'm saying is that comes relatively late. In other words, not every 23-year-old ought to have a brokerage account that they're into every day. That's all I'm saying. For me, it was a little bit later than that when that came along. Now, let's go back to Ramsey just for a second. And I've never been to any of his seminars. I've got a couple of his books. I'm not a real Ramsey guy, only because I'm almost the same age as Ramsey. I didn't really grow up with him, but I've read a lot of his stuff, and he's got what he calls the 7 steps to financial peace. And I'm just going to remind you of where investing fits into that, because I actually kind of like these 7 steps. I really don't have a single problem with these steps. His last one there, the build wealth thing, it's not my favorite phrase. I'd rather think of that phase as accumulate in order to give. But in any event, we can come back to this again. But investing is really happening, of course, with that retirement fund. It might be happening with your kid's college fund. And then, of course, you've got to balance against maybe paying your house off early. So, again, we can come back and talk through that in a minute if you want to as well. Let's see. Again, stages of life about investing. This is a little bit repetitive, but I think it's a worthy repeat. Every young person, the minute you get your first professional job, you ought to be an investor at work. Okay. Now, from about 25 to 55, what I would argue is you don't really need to be sitting down with a guy like me on all that regular of a basis. There's not a whole lot of advice I really need to convey to you from 25 to 55. And here's the way I would say it. if by that time you've established some pretty good habits about controlling expenses, keeping yourself out of credit card debt, paying your home off early, if you've got some good habits formed, then I would say just repeat for 30 years, right? Focus on raising your kids. That's what I did. Get them through college. And then around 55, from that point to about 65, then I would say that is a time to get some advice. That is a time to really make some key decisions, because you are setting yourself up for retirement. And I find a lot of people at those ages have a lot of misunderstandings about things. Like they want to keep buying term insurance and things like that, when really our job on term insurance is kind of done by then, and we should really be thinking about some other things. So again, we can come back to that, but just broadly, I would say, if you're in that 25 to 55, I mean, again, you don't need a ton of advice. I would say just keep doing the right thing, every year. Now, again, why should you invest? And these are some suggestions. And I do believe there ought to be a purpose to it, by the way. I don't believe you ever ought to invest just randomly. I think there ought to be a real objective you're shooting for. It could be college for kids. It could be your retirement nest egg. And again, I'll put as an aside out there, your greatest danger, of course, is outliving your money, right? Because all of us are living longer. We have better quality of life, better health care. And so, that's why we need a nest egg. It might be for a house down payment. And it might be like my son and I were doing there in March of 2020, might be a little bit of fun money, and we can go back and talk about that too. So what my rule of thumb down at the bottom would be, you're not really an investor unless you want to leave your money in there for about 5 years. Like I've had young couples tell me, well, Jeff, we're saving up for a down payment on our house, so we'd like to invest in the market for 3 years. I would wave them off. No, you don't want to go into the market for 3 years. There's too many bad things that could happen, and then you need to pull your money out. That's too short of horizon. You need a longer horizon. And you say, Jeff, I'm getting killed on interest rates. And it's like, I know, but you got to just get killed. You just can't go to the market. You just got to take your medicine and not be an investor during that time. Now, in what could you invest? This is kind of the menu of things that we can come back to any of these that you care to. In general, there would be a risk continuum, right? In general, there's going to be a series of investments that are going to go from lower risk to higher. Not a surprise there. Nothing. I'm not saying anything radical here. Nothing new and radical. Obviously, if you know how investments work, theoretically, the continuum is lower returns, right? Low risk, low reward, to theoretically higher reward, hopefully, right? I put the word maybe in there. Doesn't always happen, but that's our goal. And then here's a really big one that I think you ought to think about, and we can come back to it, is can I get out if I want to? I have learned a lot. I've now been an advisor for about 10 years. And I've learned that there's a lot of difference between theory and reality. You can tell somebody in theory how a REIT works and explain it to them, and they've got it in theory, but then when they call you up and say, I want my money back, and you say, you can't get your money back, they go, well, what are you running, some sort of scam? And it's like, no, I'm not, that's how REITs work. Anyway, I'm just telling you, in real life, people do not like to hear they can't get their money back. They don't want to hear that. Okay, I'll tell you in advance. And so I don't sell many REITs. I don't want that conversation. That is not fun because they feel trapped and so forth. So anyway, we can come back to this if you care to. Now, broadly speaking, just really broadly, I would say that these investments broadly line up with these age categories of people. So for example, like right here in the middle, if you were going to buy the stock market, like that fund that's going around right now, that's what Dave Ramsey would call it, a share fund. That's an A share mutual fund. That's what he recommends. If you wanted to buy that fund, if you're age 55 and below, especially if you're in your 20s and 30s, you probably ought to be a stock market investor, right? Just categorically, young people need to grow, and they've got decades to take some losses and come back from it or whatever. Now, again, you start getting up to age 55, 65, then it gets a little more interesting, and not everybody is going to want to be wholly in the market at that stage. So we can chat about, kind of how do you decide how much to do. So we'll go over to this, and then I'll give you just a couple of trends, and then I'll throw it open for questions. So I know some people say, well, I'm afraid to invest. So obviously, Ecclesiastes has verses for us about that. The old procrastination idea, and that's the reason my handout is going around now. There's always a reason not to invest, right? There are 89 reasons on that chart not to invest, so we got to be careful not to let that paralyze us. Obviously, a mutual fund, again, just like the handout says, a mutual fund, by diversification, is lowering your risk to some degree. Any one or two companies that fail, you're not hurt by it inside a mutual fund. That's the idea, diversification. And then again, what I would also say, you diversify in terms of how much money are you willing to let the market have. Like the market does not have all of my money. I have a home, right? So I have some real estate. I have some things that are in cash-related investments, things like annuities and things like that. So the market doesn't have all of my money. So that's another form of diversification as well. Couple of don'ts. Don't borrow to invest. Now, right away, there's two questions. I've been teaching this, by the way, since in the 90s in Sunday school. So these questions were asked of me in the 90s, and they've been asked in every decade since then. But Jeff, I can borrow at whatever, and I can make this in the market, so isn't that a better use of my money? So we can come back to that at a later time. Here's another one for you. Should I invest even if I'm doing so to buy rental property? Ramsey says no. We can come back to that later. I'll tell you what I think about that in a minute. We'll come back to that if you want to. This one I don't hear as much nowadays. I don't hear people say, hey, you should buy whole life insurance and it's also a good investment. Relatively a long time ago, I think a lot of us advisors have said, no, insurance has a purpose. Buy it for its purpose. Do investing uninhibited by anything else. Let investing be for itself and let insurance be for itself. Try not to, I would not recommend combining the two. And we can come back to that as well as if you want to. And again, I've already said, don't give 100% of your money to the market. All right, 4 broad trends and then your questions. Here's your broad trend. The broad trend nowadays, like I read the Wall Street Journal, every day, including Saturdays. You go, Jeff, you are a business nerd. I know, it's sad. It's really a sad thing. But anyway, I read the Wall Street Journal on Saturday. And what you'll find is, in the overall movement of the world, the focus now in investing is keeping your fees down. And you know what? That's not a bad thing. That's actually a pretty good deal because now people know that a high fee investing situation can erode my returns and keep me from making the goals that I have for myself. So that's not a bad thing that people are very fee conscious nowadays. If you use an advisor, there's 2 kinds of fee structures that an advisor may have. You may either get an asset-based fee based on the total balance you have with that advisor. That's ballpark up 1% per year. It can be negotiated. Or it can be a commission-based fee, and that would be a fee out of a mutual fund or out of an annuity contract. So those are the ways that you could pay an advisor. And then again, buying from people that you know, and again, be careful of the folks on the radio. So here's your other broad trend. Sadly, the regulatory environment in the world of investing is sending the average American to an 800 number and doing investing themselves. And it's really sad. And it started in the Obama administration. The Trump administration did not kill it off. It just didn't move as fast. And now that the Biden administration's here, the thing is back on track. And here's the gist of it. Going back to the way advisors are paid. In general now, what the government thinks is that there's too many people that get ripped off in a commission structure, so the world ought to be arranged so that everybody is in a fee-based structure where, in other words, nobody is unscrupulously getting you in and out of different things just to make a commission from you. And I understand, even regulators, it's like, I get it, guys. I get what you're worried about. The problem is, by the time we do all the paperwork to get a new account set up, I probably have about 30 pages of paperwork to set up the most basic account at my office. What's happening is it's going to price everybody out. So in other words, even though the regulators are trying to help the average guy, what they're now going to start hearing from advisors is, unless you have about 500 grand to invest, I can't afford to have you as a client because the regulatory headaches are so great, I can't justify having your account. So it's so typical of the government. It's actually a fairly well-intentioned game plan, but by the time they layer on all this regulation, the average person is going to be using an 800 number and doing investing themselves. And that's unfortunate. Now, what's funny about it, in our culture here at Morningside, we have a lot of pretty intelligent people and a lot of folks that like doing it themselves. And so it actually, this synchronizes okay with our congregation because there's a lot of people here, like we're doing tonight, that can get some general education and they kind of want to do it themselves. And so anyway, if that's you, you're in luck because that's where the world is taking you because this regulation is just unbelievable. I can't tell you how heavy it's been just in the last 10 years. All right, real quick, another broad trend. when I taught this stuff back in the 80s and 90s, a lot of the instruction back in those days, I remember teaching this very carefully. You want to get about 5 mutual funds off your menu at work, and you want to balance these out. You need some international, you need some growth, you need some value. We had all this stuff, and then you need to rebalance every couple of years. And we had entire cottage industries, entire books were written about how do you balance all the different funds that you have. Nowadays, nobody talks like that. The trend nowadays is just own the market. In other words, you're probably not going to beat the market. In other words, you're probably not going to be so clever that your little group of 4 or 5 funds is going to outdo the market. It's a lot more likely that your 4 or 5 funds, you'll lose to the market. It's a whole lot more likely that'll happen. So therefore, just buy the market. And what I mean by that is buy index funds. That's now, and I gave you examples here of about 3 of them, but that's the idea today. Just own the market. Whatever amount of money you're giving to the market, just own an index and forget about it. It keeps fees down, and it keeps you out of the regret that you didn't keep pace last year. So again, broad trend that has really changed a lot since I've been in this business. I know a broad trend. Everybody's moving to Roths, and especially younger people now. We're smart enough to tell people to do Roths. The era that I grew up in, a lot of people in here, my peers, age group wise, we were all told that IRAs were the answer. We were all told that 401ks were the answer. Well, the new mantra is Roths are the answer, okay? And we could chat about that. The problem with a Roth is you can earn too much and lose your chance at that one. So again, that one's a great one for young people whose salary is not, stratospheric yet. And then it's becoming an option for even us older folks. And some people are even getting that on their menu at work. So that's another broad trend here generally. And then, of course, the other kind of account you could have is a regular brokerage account if you don't need any tax advantages. Okay, so those are some broad trends. So what questions do you have? And then again, we'll make sure to get you out at 6, and then we keep folks around if they want to keep asking. Anybody have questions? Yes, sir.
I have a question. Since the market averages 8 to 12% returns, I had a guy who told his parents when they were downsizing their house to not put as much money down, so put a small down payment. And he's like, I'll invest that money for you. And he's like, if I don't save you what you would have saved on interest, then I'll pay you the difference. But he ended up making way more than interest rates. I know awesome. Interest rates are up,
right?
But they're still not as high as the 8 to 12%. So do you think that's a good strategy?
Well, the problem with the 8 or 10% is it's not a guarantee. And the interest that you pay the bank is absolutely guaranteed. So my feeling about it, again, you can go back to Dave Ramsey's 7 steps or whatever. What I did as my wife's in here with me, what we did as a couple is, and Ramsey talks about this, he says there's really 3 things, that group, the reason I've indented that group 4, 5, and 6 is he encourages you be working on those at the same time. In other words, be working on your retirement, meaning be in the market, but also be trying to get out of debt as fast as you can. So for our personal approach to it, when we had excess money, we took about half toward the market and half toward debt. So it's interesting what your friend did. I mean, at that moment to refinance, what they did was say, we're going to go heavier to the market, and it worked out well for them. And again, the problem with the market is we've had some weird stretches. Almost everything that everybody did from 2009 to 2021 was golden. Everybody won during that 10 or 12 year period coming out of the big recession. Then almost everybody lost money in 2022. So it kind of depends on the area you're looking at. You could look like a genius for 10 or 12 years, and then you could really look bad and give it all back relatively quickly. So again, the guarantee of paying your debt, your home off is, there's no doubt that you are 8% wealthier, let's just say if you have an 8% home loan, because every dollar you pay, you absolutely saved 8%. Whereas in the market, maybe you made 1, maybe you made 11, maybe you made 3, hard to know. Or maybe you went backward by 10. Yeah, that's the problem. So it's a good one though, and it really does. There's a lot of people that when they get to that fork in the road, we win about 50-50 because they're both such worthy goals. Awesome. Yes.
Folks that have money that they wish to invest, say they got $10,000, they're listening to your advice, they're going to jump in.
Yeah.
Do you recommend dollar cost averaging over the next 6 months or so? Or do you say go for it all?
Yeah, that's a fancy word, dollar cost averaging. We advisors have been using that for years, and I'll just explain it because it sounds more elaborate than it is. But the idea of dollar cost averaging is what a lot of us are doing at work. If your work is taking, like at Bob Jones, I think we get 26 paychecks, I think. So when they take money out, we're getting 26 investment points in a year's time. And that's actually really good in terms of math, that's awesome math because that's 26 moments. The market may have been up or down on those 26 days, but you've entered the market in a real rateable way, and you didn't prejudice yourself one way or the other. You didn't try to find the biggest day or you didn't invest on the worst day. So the dollar cost averaging concept undoubtedly is a great idea. So you're right. If I have a single dollar figure, I tell people that a lot. Like I've been in that boat several times. If you had 10 grand and say, I want to get in the market, what I would tell you to do, maybe tell yourself, I'm going to go do it in thirds. Maybe I'll do it on the 1st of, where are we now? 1st of September, 1st of October, 1st of November. And I'm not even going to look at what's happening, but I'm just going to bang, bang, and bang, 3 times and do a third at a time. And you kind of dollar cost averaged your way into the market. Then I tell people similarly, if you have a big chunk and you're trying to leave the market, you've got the downfall of what if I left right before a big upswing? Well, maybe take it out in 3 stages or take it out in 6 stages at a rateable thing that you decide on ahead of time. So I do love the idea. Yeah, really love that idea. Because on any one day, you could really have some regrets, Yes.
CDs actually doing better than some of the stocks right now?
Yes, they are. This one to me, I've been looking at this a lot the last couple of years. We have not had a lot of options in the way of CDs for many, many years. They've just been flat. It wasn't even worth driving to the bank. You could, you'd need the interest just to put the gas in your car. It's about as much as you're going to earn, getting to the bank. What I tell people though nowadays, especially guys our age, I would encourage you to look into what we call a fixed annuity. That's only like it could be 2 years, 3 years, 5, 7, 10 years. The beauty of an annuity for guys like you and me is that we could lock in today's interest rates for 4 or 5 years. Most of the CD rates that are being quoted nowadays are about 13 months. So what that's telling you is the bank believes that, money is pretty expensive right now, but they're betting, in other words, they're wanting to reel your money back in 13 months, believing that interest rates are going to go down. But if you bought an annuity now, you could lock in those rates for 4 or 5 years. So, and the reason I point to guys like you and me is an annuity is probably not for anybody who's 55 or below. It is a retirement-based product. And so again, you younger people, if somebody tries to sell you an annuity, like somebody sold me one when I was 36, worst investment ever made, should wring the guy's neck. But I won't go into that, and I'm not bitter about it or anything. I'm not still suffering bitterness about it. Not at all. I'm over it, I promise. But anyway, that was not a good thing for me at age 36. So don't buy an annuity at 36. Okay. Others? Yes, ma'am.
So if you're investing in 401k through work and you change jobs,
yes,
how does that money you invested go with you?
Yeah, that's a great question. 401ks are what we call portable, and that's actually one of the best things that is in the act that created 401ks, that it goes with you to the next employer if you choose to do that. And so if you believe your new employer has a really good investment menu that you like and you believe you're going to be there for an extended period, you can probably roll your balance from one employer to the other and really just have all of your money in one place. Or frankly, when you leave an employer, you have an opportunity to roll it into an IRA. And some people would argue that gives you even greater control over it because now you're not limited to the company menu. The problem with an IRA is now you're paying all the fees, where I would encourage you, let the company pay your fees. Let them be your investment broker, and I would keep your money at work. I wouldn't be dying to go to an IRA and pay extra fees. So yeah, you can roll it over. Now, I've got a couple of my kids now that are in their early 30s, and they've only been at some jobs. One of my sons, for like a year at a time. It's like, I don't quite know what to tell him, whether it's even worth the trouble to roll it over, even if he's not going to stay put longer than that, But if it's a relatively smooth thing, now again, some employers, if your balance is like below $5,000, they may cash you out, so to speak, because your balance is so de minimis. In other words, they may not let you keep the balance around. But others of them, if your balance is larger, like I moved from an employer one time and left my balance at the old employer, and I was in no hurry to move because it was a great plan. They had a great menu. I knew they were going to really manage it well. No hurry. I had two statements, two 401k statements, but no harm done. So you don't have to do it, but it is available to do it. Yeah. Other questions? These are awesome. Great. That way we know we're getting to the things you're interested in. We'll be Paige back there. I'll ask you guys a few questions. You got any for me? Okay. Yes, sir.
What do you say to some of these YouTube financial gurus like Greg Cardone and people like that are saying debt is good, and of course they're total opposite of Ramsey or
right,
maybe like you.
Right. Well, again, a lot of this, as far as debt's concerned, we were talking, Pastor Warren and I were before, like there are businesses, and of course I teach business, So in business, we teach that you can borrow money, and in business, you can make a return on it and pay it back. So I guess I would have one mentality about debt in business as a business strategy, but as a personal strategy, I think the sooner you can get out of debt, the better. You know, the Bible has a lot to say about debt. It doesn't condemn debt, but it tells you that the borrower was servant to the lender, right? Or really, in the real language, that's borrower is the slave to the lender. So for us, my wife and I, we wanted to get out of debt. And the way I would phrase it is the minute we paid off our home, that was many, many years ago, but I have never wanted anything in life, and I've never had any investment opportunity in life that has been important enough to me that I wanted to borrow money to get in on it, because the feeling of being debt-free is so awesome. So in that regard, I'm a real Ramsey guy. Again, he's really my peer. So I mean, he came along, but in other words, he celebrates these folks getting completely debt-free. I'm a believer in that. I've lived through that. And I personally don't want to go back into debt to invest, even on a real estate property, where again, you could make a business case that, well, wait a minute, that's an appreciating asset. And I wouldn't throw a rock at a person who says, I'm going to borrow to invest in real estate because it's secured by an appreciating asset. You know, I wouldn't personally throw a rock at him. Ramsey would argue, don't do it even for that. In other words, his point, and kind of like mine, is you want to get out of debt, and you want to celebrate that so that you never ever go back there if you don't have to. And I think the idea of investing is that's a voluntary, going back into servitude. And why would I ever voluntarily go back under that servitude if things go bad and then, can't pay it back or whatever? So yeah, these guys that preach that, I mean, again, in a short-term period, it may work pretty well for a while, but you can have some big reversals too.
So I guess in the first place, if your outlook is that way, then why would you advise, not that you had said this, but why would people advise young people or anybody to have debt to have a house?
Well, I think, that's a great question. Why would you, we call it the American dream, is to buy your own home and have your own home and have it paid for. And so a lot of preachers, I think correctly, they criticize the American dream. We're all too caught up in it. It's code word for being greedy and materialistic, and I get all that. However, as an investment advisor, what I would say is that little part of the American dream, the fact that you do buy a home and then steadily pay it off over a lifetime, that one is probably the one sound thing that every American actually does. That one is not, in my opinion, that's not something you should criticize the American dream. And here's the reason, very simply. When you arrive at 65, you got to have somewhere to live. And you're going to leave your income-paying job, and you want to have the biggest budgetary item of your budget off the table. So you want to own the home. Now remember, even then, you're still going to need a new roof every 10 years. You're going to need new HVAC every 10 years. So you're not totally home free. You got property taxes and you got home insurance. So you're not home free at 65. But what you don't want to do, and sadly a lot of my peers, what you don't want to do is enter age 65 with a ton of debt. Maybe they've just bought a new home, or they've upscaled, or they've remodeled. And now when you leave your job, you just can't make the numbers work. You're leaving your income behind. There's no nest egg big enough to take care of all that new house payment and all that debt. So ironically, that one thing that Americans do, I really hate to see us become a rent-only crowd, which I know I hear that a lot nowadays. Because, man, that's the one thing most people do that's actually sound. That, okay, you at least own your home. Okay, thank goodness. Okay, good. All right, we can at least work with that, when we're getting ready to retire. Other questions? Yes?
So what does REIT stand for?
REIT is a real estate investment trust. And that was the example I gave a minute ago of one of those things where a lot of them are privately held. And so what it is it's these big money folks getting together and saying, okay, you'd like to get in on, let's say, owning an office building or whatever, but you're just kind of an average American. A REIT is your way to get in on the idea of owning a doctor's practice, or owning real estate, or owning a mall, or any high-rise tower. And so a REIT, it has its place, and it's called what we call an alternative means. It's kind of, if I could diagram a risk curve, it's way out there in terms of risk. And to me, the biggest thing about a REIT that gives people trouble is the example I gave a minute ago, is if it's a private REIT, you have no way of getting your money back. And that really bothers a lot of people. Like, I had a woman call me one time, and I had sold her this as a favor to a friend of mine, and, really regretted it, because this woman called me and she said, I've got 20 grand in this REIT and I want my money back. And I said, well, you can't get your money back. And she goes, what do you mean? It's like, you can almost hear them. They're dialing their lawyer. They're dialing, I'm getting ready to be sued here by lunch, And she goes, what do you mean? And I go back and look at her statements, and I said, well, they've already made distributions to you of over 20 grand. Didn't that feel pretty good? She goes, yeah, I love that. I goes, well, that was your money. That was your money coming back. But she's like, no, my statement says I still have 20 grand and I want it today. Oh, brother, it's like, oh man, don't ever do a favor for this woman ever again. Don't ever do that. But anyway, it just showed me that people really don't want to be trapped with their money. Now, in her case, we had a happy ending because it turned out her REIT was actually publicly traded. And so she, in fact, could sell hers just like selling shares of stock. So in her case, she actually did get out, and we had happily ever after, which is nice. Yeah, it's great. But it really taught me a lesson that you could tell people 100 times that it's illiquid, and they're not hearing you. But man, when they say, I want my money back, and you say, I can't get it, it's like, Jeff, I don't like this. I don't like it. This is not what I thought I was getting here, So, all right, time for one more question. Time for one more, and then, yes.
I noticed you said you didn't recommend investing in gold or silver.
Yeah. Well, that's one that I knew might come up tonight. I'm really not recommending against those things at the bottom. I'm just saying that I'm personally not going to guide you in there. And I have some clients of mine that own gold and silver, and at different times I think it has done pretty good for them. But again, my expertise is in financial investments. There's an argument that gold and silver is not really an investment at all because it doesn't provide a return, and it's liquid only if there's another guy willing. In other words, there's not a ready market necessarily. I mean, generally you can sell it or whatever. So I personally have not been a gold investor. Some of my clients are. I just don't personally lead them into that myself. I'm just a little bit hesitant to it. And I'll be honest, one of my arguments, and the reason I don't do crypto, if any of the young guys are interested, is that the market has been so good to me. I think so much money doing investing in traditional avenues that I haven't felt that I needed to go to those extreme risk areas to get a decent return. In other words, I've actually been quite satisfied with the market. So I guess my alternative is some of these folks looking for returns in those areas. I feel like, well, especially like through 2021, my goodness. I mean, we had some banner years, there in the late, from about 17 to 21, my goodness. Those were fabulous years. I don't see how anybody was doing better than that in the alternatives. So, but there are people that are good with them, no doubt. All right, very good. Well, I'll tell you what we'll do. We'll wrap things up here, and then if a few of you have other questions, we'll stay around here after 6 o'clock. But I'll just wrap it up. I'm a teacher, so I'm going to always have more material you should be reading, right? And you're going to think that I paid off Pastor Crockett from this morning, but I had my slides done a long time ago. But he recommended a Randy Alcorn book, and I love Randy Alcorn for this. And Randy Alcorn in our circles is known for writing the book about heaven. And it's a very, very good book. But he's written 3 really great books about money. And the 2 that I've got on here are 2 that I really love. The Treasure Principle, as Pastor mentioned, is just awesome because it focuses on just that one thing. And that is, are you heavenly minded when it comes to money? And it's a more stern test than you think, I'll tell you. Now, this other book, though, this Managing God's Money book, if you had to only read one book, that's the one to read. Now, here's the reason I say that. You can buy, I've got Ramsey's books up here at the top. Ramsey, if you say, Jeff, he's got 15 books. In my opinion, he's really got 2. He's got 2 books, and they're all reprinted editions and all this. He's got 2 books, really. One's called The Total Money Makeover, and the other one's called Financial Peace. And I have both of them, and they're good. So here's what I would say. If you need help on the basic blocking and tackling of managing your money as maybe a young couple, just getting your finances set up, read those books of Ramsey's. They're great. I mean, I really do agree with about 99% of that. That's fine. But what I love about Alcorn, and I think for our crowd here, a little more maybe a biblically sound crowd, highly educated crowd, I think you'll really enjoy Randy Alcorn because he's a theologian looking at money. And so what he does, for example, in that book, highly convicting, he takes the first 5 chapters and he says, are you materialistic? And you're going, Jeff, I work at Bob Jones. I'm not materialistic. You're going, well, I'll tell you, you read those 5 chapters and I'll tell you, you can't, he'll nail you. You're materialistic, I'm pretty sure, and I'm pretty sure I am. Because man alive, he is good at really showing we are not heavenly minded with our money. So anyway, I'm a big Randy Alcorn fan. Thank you so much. I appreciate the recommendation today. Now, these other 2 guys on the right, I am trying to keep these 2 guys' stories alive. I'm doing this on purpose because I teach young people, right? I'm an old guy and I'm teaching young guys. So I'm trying to keep young guys aware of these stories because I don't want these 2 guys to be forgotten. The first guy there is a guy named Stanley Tam, And he got involved in business back in the 60s when plastics was the thing. It was like the Apple of that day. And he got involved in that. And he's a guy that gave God 100% of his business and literally paid himself as an employee. And I love that story of really lavish giving and how God really honored his heart's, motivation to literally just live as an employee, even though he had built this incredible business. The other guy on the right, I love as well. I bought this book and I've recommended it literally for now about 30 or 40 years. R.G. Letourneau is the guy who started a business in 1929. No kidding, 1929. He was 40 years old, a very unlikely guy to start a business. Terrible year to start a business, 1929. And he was a guy who was an inventor, and he was a creative genius in building big earth-moving pieces of equipment like you might see on an interstate highway today. Those big gigantic things, where the tires are, bigger than your house, And he developed a lot of the technology behind it. Well, he became a multimillionaire. But what he and his wife did relatively early in the business is he gave 90% of everything he made, 90% of the company stock, 90% of the profits, and lived on 10%. And on the 10% became a multimillionaire, which is just awesome. And he's just a wonderful Christian man, a real a soul winner, a guy. He was a well-rounded Christian guy. And again, if you want to put it in context, he was a contemporary of Dr. Bob Sr. So they would have been living in about the same era. So if you want to kind of place him in history, but it's just an awesome, awesome read. He's just a fabulous guy, and I highly recommend it. And my point there is I want to keep these stories alive of some of these real pace setters, some of these men who really exercised faith, and I really want to inspire, like a lot of my young accounting majors. I got a couple of accounting parents here with me tonight. I want to really inspire them to be givers. I want them to be the R.G. Letourneau of today. I want them to be the Stanley Tam of today. So I want to keep those stories alive. So I want to recommend those to you. All right, at 6 o'clock, I'll let you go, and have a great week. If you want to hang around, we'll chat some more, and we can chat as long as you want.